It's been funny to watch the evolution of Bitcoin's position within these hedge funds because back in 2020 and 2021, none of these hedge funds owned BTC. They were like, if you want BTC exposure, then you should buy yourself on Coinbase.
95% of the hedge fund manager outperformed Bitcoin. It is the best asset class in the world, even outperforming Nvidia in past 10 years.
Ben Jacobs is the managing partner at Scenius Capital, a digital assets investment firm he co-founded in 2021. With a background in e-commerce, including founding and successfully exiting Power Hour Tower, he has transitioned into the crypto investment space. He has reviewed over 300 funds and backed some of the sharpest investors.
Now we are evolving to an era where simply being a crypto technologist or early to crypto, that ARB is over. And now you need to be an actual VC. The best founders are attracted to VCs who have either built a company or who they can use as a sparring partner to challenge their assumptions. So I'm in favor of high IQ.
Hello and welcome to Build It Up, where AI meets crypto, technology meets humanity, and East meets West. I'm Bill Chen, the co-founder of Cypher Capital. Subscribe now and be part of the conversation. My guest this week is Ben Jacobs. Ben is a managing partner at Scenius Capital, a blockchain-dedicated fund of fund spanning liquid and private strategies. Ben is also the host of Scenius Studio, a podcast exploring institutional investing in crypto and digital assets. Ben, thank you for joining us.
Thank you for having me. I'm excited to be here.
Awesome. Yeah, let's get started. You are the very few founder of the funnel hedge fund deployed into both liquid and illiquid strategy. Is that true? And how did you end up with this strategy when you founded the Scenius Capital?
Yeah. Well, first, thank you for having me. Excited to dive into my background, Scenius, my perspective on the market. So, yeah, I got into crypto about a decade ago. I didn't come from the world of traditional finance. I never really saw myself as a trader, nor was I technical. But I just saw promise in this technology and started buying BTC, ETH, Litecoin, and some other coins from that generation. And over the years, just by being patient and long was an effective strategy. However, as the asset class continued to expand, it required a trained eye. It was very difficult to discern what were good tokens, what had merit, what could drive a narrative, and how could one invest thoughtfully to generate outsized performance above and beyond just holding BTC and ETH. So I spent a lot of time trading around myself and trying to figure it all out. And what I realized was it requires a team, it requires understanding of operational infrastructure, and just the knowledge of what tech actually had meaning. And so I decided that I wanted to outsource my investing to those that were best suited to do so. So I spoke with VC funds, hedge funds, and this was all around 2020. And while I was impressed by the VC funds, I actually thought the liquid token hedge funds were effectively VC. They had the same asymmetry and that they could capture opportunities, generate a multiple. But the good thing with crypto was that they could exit and there was better liquidity. So together with my brother, we founded Scenius Capital with the thesis that people would be willing to pay for access to a diversified, diligence basket of active hedge fund managers. So we launched that strategy in May of 2021, and we were one of the few fund of hedge funds that survived. And we can dive into why that is, but it's been very difficult, A, to outperform BTC, if you consider that an appropriate benchmark. B, there's been innumerable landmines from operational crises to funds not having sufficient operating capital or being so beneath their high water mark that they are unable to sustain business and attract talent. And then it's been difficult to raise on the fund of hedge fund side and for all liquid token hedge funds. So we're seeing a number of changes occur where there's consolidation, various hedge funds in the asset class, an evolution of trading strategies. You can't simply just be long a basket of alts and expect to outperform, as I think the concept of an alt season is dead. So yeah, we've probably invested in more liquid token hedge funds than anyone else out there. And we've continued to expand and broaden the business to the venture side as well. But we started out with the fund of hedge funds and have been running that vehicle for almost 4 full years at this point.
For both strategies, at this point of time, I wonder how challenging is it to perform Bitcoin in past a few years? Because you have seen so many general partners globally, right?
First, I think we just need to set expectations. Bitcoin is the top performing asset of all time. The last 10 years, it's been exceptional. So even though you're underperforming Bitcoin, uh, even if you're still within the same band, you're doing okay. I think that's one clear point. I think a lot of the hedge funds, I'd say 95% have underperformed Bitcoin during the last few years.
Yeah, but in the traditional hedge fund industry, especially for the equity focus, if you underperform S&P 500, even your benchmark is cash, right? You generate the carry and bonus based on the cash return, but still the LP gradually might leave that GP to some extent. So what is your view on that? Do you think Bitcoin is a legit benchmark, or still the cash return shall be the benchmark for the crypto hedge fund and the crypto VC?
Yeah, it's been funny to watch the evolution of Bitcoin's position within these hedge funds because back in 2020 and 2021, none of these hedge funds owned BTC. They were like, if you want BTC exposure, then you should buy yourself on Coinbase or your altcoin exposure. And these are the fundamental discretionary funds. Then, as it became clear that Bitcoin dominance was going to rise and that institutions were going to come in, all the liquid token discretionary fundamental funds started making Bitcoin their largest position. And now, with the proliferation of BTC and the spot ETFs and the various ways to get BTC exposure, I think allocators are looking to the liquid token hedge funds as a way to get broader digital asset and blockchain exposure. So they are capable of buying IBIT or buying the Bitwise, but the crypto native hedge funds are responsible for two things: timing the rotation of Bitcoin to alts and also determining which alts actually have merit and actually will have dispersion of performance. We can no longer rely on retail to buy the VC's bags of anything that's okay, because they have meme coins and other ways in which they can speculate. It's like the VC infra. So it's up to the hedge funds to determine what has the right narrative, what is generating revenue, which has actual product market fit. And those alts, I think, over the next 24 months will outperform BTC as BTC DOM goes down. But it requires a trained eye to determine which of those alts actually will outperform.
So basically, you are mentioning the money manager in crypto, regardless it's in VC or in hedge fund, basically they provide the timing and altcoin alternative solution to the asset allocator, because as allocator, they can invest in Bitcoin by default if they are interested. But your solution and your portfolio, aka the fund manager, provide the alternative of the market timing and altcoin selection.
Yes, that's correct. I think there's a number of different ways to invest in the asset class. I think historically we've seen allocators be most comfortable coming in through venture. As we all know, crypto is immensely volatile with monthly mark to market on the liquid token side. A CIO who has never experienced, plus 25% months, down 30% months, it's difficult for them to underwrite and especially to bucket it within their hedge fund mandate. So they lump liquid token funds and venture funds together in their venture fund bucket. And they'd much prefer venture where, it's a longer duration, you have quarterly marks, it's not as volatile. They understand it as a way to get exposure to this emerging technology, but they don't really understand tokens because they don't see them having any fundamental value. And I think that lack of ability to underwrite these tokens and the valuations they're achieving to allocators who don't spend enough time in the asset class, they admittedly just get a little bit lost. So they allocate to Bitcoin, which they understand as a digital gold alternative. And they look at venture as a way to basically get access to stablecoin infrastructure and Web3 experiments. So it's the liquid tokens that I still think some of the allocators don't really understand. And that's why it requires a lot of education. And I think regulatory clarity so that these protocols can actually know the lines within which they can draw for their tokens to actually accrue value and distribute cash flow or do buybacks, whatever they might do, such that institutions know how to underwrite them through the same lens they would underwrite like an equity, if that's the right framing.
And you just mentioned from your observation, 95% of the hedge fund manager outperformed the Bitcoin. Even Bitcoin has been more than 16 years old, but I think part of the reason is because Bitcoin, the performance is so strong, right? It is the best asset class in the world, even outperforming NVIDIA in past 10 years slightly. My team just did backward analysis. Having said that, how about the VC manager? Do you think VC managers still like 90% outperform Bitcoin, or it's slightly different?
Yeah, first, one final comment on the hedge fund side. So there's a range of different hedge fund strategies. There are long bias fundamental strategies, but then there's also DeFi strategies, quant, systematic. And so one strategy that we found as a way to have Bitcoin exposure, but also generate additional value on top of that is to allocate to the Bitcoin denominated share class of a delta neutral strategy. So with that strategy in 2024, we own the Bitcoin beta, but we earn 30% more Bitcoin. So I
Wow.
think these Bitcoin denominated, ETH denominated, SOL denominated share classes are highly compelling. And if you were to assemble a portfolio, they're an important one to consider, especially because Bitcoin has done so well. So that's a final thought there. On the venture side, yes, many of the venture funds have underperformed. It's also early in many of these venture funds' lives. Venture.
Do you mean this season?
So, I mean, it depends on the vintage, right? Many of the 2017, 2018 funds that launched then, the average return is exceptional, 10 plus X.
Yeah, that's a golden age. Crazy.
That was the golden age because you could throw a dart in dark room and you would hit something. And there weren't that many deals. It wasn't that competitive. Things weren't marked up to some exorbitant valuation. And retail was still buying these tokens. So that was a golden era. Then as crypto started performing, more funds came in. Some of the early successful funds started raising much larger funds. And all of a sudden valuations were inflating. The venture funds were deploying into liquids. They were spraying and praying. They didn't really care about valuation because they always thought that they'd be able to exit to retail. That game is over. So I think now we are evolving to an era where simply being a crypto technologist or early to crypto, that ARB is over. And now you need to be an actual VC. You need to be disciplined around valuation. You need to have a thesis on an area of crypto or a fundamental understanding of commercial businesses and how crypto could potentially permeate them and disrupt those industries. So I think similar to in the traditional world, like many venture funds will underperform. The average is going to be sub 3x, maybe not in this vintage, but I think ultimately returns are going to compress. And however, as we all know, venture is an outlier game. And there will be a few funds who are able to consistently attract the best founders at the best round dynamics and who have the right fund size. And they will be able to consistently generate IRRs that are superior to that of the average crypto hedge fund or some benchmark. So I think we're going to see fewer funds deliver that outperformance, but I think that's healthy as the asset class matures. And also as generalist funds begin to redeploy back into crypto. So you're seeing Founders Fund being far more deliberate in crypto. You're seeing Khosla and Kotu. All these funds are dipping their toes back into crypto, specifically like stable coins and things that they sense have real merit.
Not only equity, but also into the token only projects.
They're dabbling again. I think a lot of them got hurt in the last cycle. And so they're being far more, I'd say, conservative but
Mm.
they are not afraid of getting back into the asset class.
What do you see the vesting schedule? I mean, the vesting schedule from my observation, in the end of the day, the founding team, the exchange, the market maker, they can front run upon the listing. But, all the venture capitalists, they are handcuffed because of the lockup and the vesting. Sometimes we had a conversation and discussion, make a joke that when a lot of VC, they began to invest it. Pretty much, maybe half of the project, half of the founding team, they already retired already. So what is your view on the vesting schedules, this industry practice?
Yeah, I think we've seen an evolution in vesting schedules over time in crypto. Historically, back in 2017, there were ICOs, there were fair launches, there were attempts at, having tokens just totally unlocked day one. That has pros and that has cons. The reason there are vesting schedules often is because it takes time to build something meaningful. And you don't want, like, in a year in or 2 years into building a product that is supposed to change the world, you don't want your founder overly indexed on a super volatile token that is not really indicative of any fundamental merit, but more so on narrative, hype, broader macro, etc. So there's a reason that VCs exist and there's a reason that vesting schedules exist. But I think there's a constant tension between wanting to have the token as the product, I think a little bit short-term thinking. But then there's a case to be had for there being honest price discovery and giving access to a broader network of potential participants and owners in it before it's the token has accrued a value where it's multi-billions and then all the VCs are unlocking and then they're dumping when retail first has the opportunity to buy. So I don't think crypto has totally cracked the code. We've seen teams like Jupiter and Hyperliquid. The teams were totally bootstrapped themselves and didn't take venture dollars. And that's great. But those founding teams were very wealthy. That's not the case for the many first-time founders and founders in the asset class. So I don't have the right answer as to what the right vesting period should look like, if there should be a vesting period at all, or when you should launch your token. I think it's a constant evolution and experiment. And sometimes, we see venture-backed projects do exceptionally well and launch at $1 billion plus valuation and still do okay in the public markets. And then we've seen other times where they just bleed out. We've seen the low float, high FTV meta kind of trickle out and people kind of understand the game that's playing and adjust how they're playing it. And so, yeah, I don't have the right answer, but I do know that it's important to continue to monitor because I had no right solution.
Yeah, it evolved and change along the way, right? I mean, like before this cycle, it's very difficult for us to imagine for Hyperliquid, those type of self-bootstrap team become the superstar in this cycle. I have a follow-on question regarding this. When we see the Hyperliquid and then the community discuss, do we still need a institutional VC anymore? In Web 2, in the traditional internet, gradually the VC become a mega asset management industry, from 100 million, 200 million for a VC fund until Masayoshi launched his 100 billion fund because they want to convince all the Web2 founders stay private as long as possible, because in that case, you can focus on building your economic moat, building your size advantage until one day, when the time is mature, then you go to liquid, you go to the IPO. That is the involvement of the VC in traditional world. For the crypto, do you see the VC fund be growing their size, or it's going to be a very limited size asset management industry? What is your view on the perfect size as a VC fund in the future?
It depends, right? Like, what are your goals? If you're Andreessen, you're managing multiple billions and you're a large institution, a pension fund, an endowment, a sovereign, you're okay with getting a 2.5 and 3x. You just want to know that your capital is in trusted hands with a big, robust team with good reporting that does audits, that uses all the right service providers, that does things by the book. And you're okay missing some upside. You're not trying to get really rich. Like, you just don't want to lose money and you want to go to your boss and say, hey, I did a good job and
Yep.
outperformed some benchmark by 1%. If you're a family office or a high net worth or someone further out on the risk curve, allocating to a very large fund in crypto like that presents challenges. One,
Mm,
because there aren't that many crypto native opportunities that actually have enough merit to them where they can generate outsized performance. So for us, we've oriented around investing with smaller managers in crypto. Our average
mm.
fund size is 36 million.
Or both hedge or VC and VC?
Just for the VC funds. I think
Okay.
there's also dynamics on fund sizes on the liquid side, but for us on the venture side, we've oriented around smaller funds because we think for them, they could put in a 500K check or $1 million check into a seed round. And then there are many large funds in crypto, like that seed stage company does well. They are going to plow 10 to 20 million bucks into that company because they need to deploy capital into things that look good. So for our funds, they have downstream buyers from them. If you look at many of the large funds, they have to deploy a lot, and the institutions aren't buying tokens yet. And there aren't many hedge funds in the traditional world who are buying tokens yet. And the liquid token hedge funds don't have that many assets to buy tokens yet. So the downstream buyers for many of these large funds don't really exist. So for
Mm,
us, we'd rather allocate to smaller funds that have the next buyer that can be a crypto native fund that is larger. And also, so they can put money in and say they have a 500K investment in their $20 million fund and did 20Xs, they return half the fund. And that's very plausible within crypto. But like for a larger fund, putting a 500K ticket in doesn't make sense. Otherwise, they're going to be managing hundreds of companies.
So in general, you agree with that size diminish the return, even in crypto world, right?
Yes, absolutely. And again, it depends on what the LP and GP's mandate is. If you're Andreessen and you're managing a $1 billion fund and you return a 3x, you're going to make a lot of money on the carry there, and
Yes. Yeah.
your LPs will be happy. So
Mm,
yeah, everyone has their own incentives, and like the large AUM game works for some folks.
mm.
But if you're a high net worth or someone looking for outsized returns, yes, there's more risk, but you have to look at smaller funds, is my contention.
Yeah. For this cycle, I wonder if we compare the hedge fund and VC, which asset class outperform?
It's tough to tell, right? Because venture has a longer duration to it. I guess specifically if you're investing in the equity of businesses, it takes time for there to be acquisitions, liquidity events, M&A, going public via traditional means. That takes 5 to 10 years to materialize. And then also these venture funds, they have multi-year investment periods versus many of these hedge funds, their net exposures between 60 and 100% at any given point in time. So the venture funds are deploying hopefully relatively slowly,
Mm.
anywhere from like a 2 to 4 year investment period. And it requires time for those investments to kind of bear fruit. So I think down the road, we'll be able to compare those two. Like if you were to evaluate IRR and the time value of money, et cetera, and factor in things like liquidity, what would outperform? It's tough to say, again, because it depends on your preferences. You might not want to deal with the volatility, or there could be tax implications if your hedge funds are actually selling positions. Because, say, it's a multi year lockup hedge fund, you live in the US and you're dealing with cap gains and short term and long term gains. Like, if your hedge fund is very actively trading and you're locked up and they generate exceptional performance in 1 year and you incur all those gains, you need to pay all those taxes, but then they don't protect capital the following year, your capital account halves and you just paid taxes on gains from the year and you didn't see any actual distributions. So there's a lot of nuance in that thinking: taxes, stomach for volatility, timeline, your return targets, your preferences, all things to consider. And I hate to hedge all
Yeah.
my answers, but it
Mm.
really does depend on the audience.
For a very newbie institutional allocator who hasn't built up any exposure in crypto, what would be your advice to them? Shall I just get into the allocation into the hedge fund or VC, or shall they just buy their IBIT first? So what would be your suggestion for them to start the journey?
There are a number of ways to go about it. I think Bitcoin is its own beast, and I think should be owned by every single institutional allocator. What is frustrating about crypto allocations in general is that institutions and LPs in general tend to move fastest and make their deployments in like the late innings of a bull market.
So that's a very bad timing.
They tend, and then they're bitter because crypto corrects, and then they're down good, and they have to tell their boss. So my first recommendation would be have a multi-year plan. If you were advising your mom to do a trade, you would say dollar cost average in. And I think that can be a multi-month. It could be every month you're putting in a little bit, every 3 months, every quarter. You're doing it deliberately over a multi-year long period. That would be my first piece of advice. And
Yeah.
you're buying dips.
Otherwise, a lot of people, they get the vibe in the bull run, so they ended up with buy high and sell low. Buy high in the bull run and then depressing the bear market and sell and just leave.
Exactly. And it's immensely frustrating, but it's human nature. And we all know the
Yes.
quotes, buy when there's blood in the streets. So that's why I'm saying don't buy necessarily when there's blood in the streets. Buy when the streets are bloody, buy when the streets are calm, and buy when the streets are feverish. Just make sure you're
Yes.
dollar cost averaging in. There's so many factors. Then you need to consider a broader allocation. If you believe that blockchains will have a role in how financial infrastructure will function, and if you think that Web3 can permeate other industries and things like DeepIn and Web3 gaming and identity and crypto and AI intersecting have any merit to them, then you need to consider participating in VC and in the liquid token front. And then similar to how you would evaluate a liquid token hedge fund, or a normal hedge fund, there's a range of different strategies. If you want access to lower vol, you can access strategies like that. If you want to construct a portfolio that has a certain Sharpe ratio, you should evaluate, here are the long biased funds, here are the more systematic, here are the trend following, the momentum funds, the delta neutral, et cetera, et cetera. So think about what are the types of funds and what are the return targets you're going for. And then talk to various managers or talk to a fund of funds that has spent a ton of time doing that. Maybe there can be an SMA type product, or maybe a fund of funds that serves your exact needs, or maybe you have a robust enough team to assemble a portfolio that serves your objectives. Then on the venture side, I think you need to evaluate, what do I want? Do I want higher octane potential, smaller funds, higher risk? Or do you want a fund of funds that does that? Or do you want to go to some of the bell cows that you know are going to have more capital, but they're lower risk? And so I think it's important to meet as many managers as possible, like do the work and allocate slowly across multiple vintages as well, because it's impossible to time.
Awesome. Yeah, I think that's very well said. And I have a follow-on question regarding to select the right money manager. I think there is a very interesting debate about what is a very good venture capitalist. Some people say they have to be super smart with a lot of intelligence capital. Some people say you don't have to be very smart, but you have to have a lot of social capital, be along with all the phenomenal founder. Even you are very mediocre IQ, as long as you are surrounded by phenomenal founders, you just bet on them and then you can be an outperformer. So social capital and the intelligence capital contribute to a good VC investor. What is your view on that? How do you select your VC fund manager portfolio?
I am in favor of IQ over EQ because I find that in this day and age, it feels like everyone thinks they're an investor, right? Because they got early to crypto and they made some money. However, I think very few VCs have excellent taste, meaning that they've spoken to many founders. They have deep thoughts about how this tech can actually be implemented, and they are able to discern what's high quality and not in terms of both an idea, but also the founder. And so I think, yes, like the best founders are attracted to VCs who have either built a company or who they can use as a sparring partner to challenge their assumptions. So I'm in favor of high IQ. I also believe that, again, I briefly alluded to it earlier, that the days of being a pure technologist who only understands crypto and having that be your source of edge are over.
Why is that?
So I think crypto is very similar to the internet. And we've all heard about the analogies of internet adoption to crypto adoption. Yes. But I think the more interesting component of it is crypto is an enabling technology. I think all enterprises, all corporates, and many startups going forward are going to use stablecoins. They are going to have elements of decentralized storage as part of their technical architecture. So more so, the VCs need to understand other industries and how crypto can influence them. And I think the first examples of that, like crypto, is disrupting banks and financial infrastructure.
Yeah.
Then it attempted to disrupt the art market. That was brief and didn't have much merit, but it shook it up a little bit. And now we're seeing attempts at disrupting science and biotech via some of the DeSci experiments. We're seeing attempts at disrupting physical infrastructure networks like telecom and energy and car data. And now we're also seeing gaming and AI. So I think if you were to talk to many successful AI investors, they'd be like, yeah, many of the quote crypto AI investors don't know much about AI. They know a lot about crypto and they have some semblance of an understanding of AI, but they don't really understand the big shifts in the technology. So my thinking is the best venture investors in crypto that are high IQ are really figuring out what matters in robotics, AI, spatial computing, these other frontier tech industries, and they understand how crypto is going to permeate them. Because I think the next wave of outperformance is going to come from commercial applications of this technology, not just building crypto infrastructure and crypto native trading apps for the 10,000 people who are active on chain.
Basically, you think the intelligence capital is also super important to a VC capitalist, right? Even the dual sourcing capability is the must brag stuff when all the VC manager who are fundraising from the asset allocators.
That's why I think Twitter matters. I think you post Twitter matters, your blogs, your investor updates. Word permeates to the broader zeitgeist of what you're thinking about, some of your beliefs, what you stand up for, what you think is important. And then that enables founders to align with you. Maybe they want you to lead their round, or maybe they'll reach out saying, hey, I'm thinking of starting something, would love to pick your brain on it. And so I do think having your own independent thoughts matters. EQ, of course, matters in that you're friends with a number of people. So you're constantly having conversations and at the right networking events and invited to the right events. And obviously it's a balance, but I do think IQ is becoming increasingly important as there's so many high EQ people out there, and crypto is just networking between all the different conferences and things, that it requires a high IQ to really delineate what has merit and what does not.
On top of that, I have one last question. A lot of young generations, if you being a crypto hedge fund investor or crypto VC investor is so cool and a very promising career. But what would be your advice to them? There's two types of paths. One is just to go directly, get intern, get into the hedge fund and VC. And another part, people might argue, Michael Moritz from Sequoia, he started a career as a journalist, right? A lot of partner in VC actually start their dev, ops, marketing, research job first, but in the end up as a investor. What is your view on that? How are you gonna help to design a career path for a young generation who want to get into the investment career in crypto?
It's a good question. I'm very much in favor of spending time learning how to operate. Similar to how there are many VCs that I don't think have opened up MetaMask or Phantom in 2 years or done any
Oh,
on-chain.
really?
I just don't think like they're really using the tools. And
Mm,
same goes with the hedge fund managers. I think if you actually use the tools and experiment and tinker, you see some of the flaws, you see some of the pain points. So I think
yeah,
similarly, if you're trying to scale a protocol or build an app or do something where you're bridging assets across chains, you're going to identify pain points. And so I think a good investor knows when a founder has identified a pain point, something annoying that, if solved, people would be willing to pay a lot of money for. And I think it requires being in that operator seat to understand how difficult some things are, and then maybe to identify a specific pain point that is worth either investing in, so looking for a founder who's trying to solve that particular problem, or building it yourself. And I think in crypto, what's cool is that it's a very open community, and even
mm,
very senior people are reachable. You can get in touch with very senior people and accelerate your career very quickly. That was one thing that I loved is I had never been an LP in a fund when I first started out in crypto back in full time in 2020, and I was able to get in touch with many of the biggest funds in the space and just learn from them directly. And then there's podcasts and people are very public, so you can learn.
you think understanding the business from the trenches in a very granular level, using the product, being an ops, like those type of thing will be the valuable assets for a young generation. They want to be an investor in the future.
Yeah, I just think that the alpha of being in crypto and thinking that's sufficient to make money now is no longer there. And so
Okay.
you could spend much of your time thinking you're a genius and just trading around, and yes, you might make money, but I don't think you'll fundamentally understand how things work, and your edge, your long-term edge that you're aiming to cultivate if you do want to be an investor would be much sharper if you've actually been in the seat of
Mm,
some of the teams that are building, or some of the founders or operators. So I think there's a lot more empathy, and investors who've only ever been investors may not have the same empathy for the
mm,
operators and founders, and may not be able to resonate with them as well. So
yeah.
I think empathy is a core part of being a good investor, someone value add, who then founders rave about having them on their cap table.
Yeah, that makes total sense. Wow. Thank you, Ben, for all the insightful sharing, and I really appreciate your time.
Yeah, thank you so much for having me. And for anyone listening out there, as you can tell, I'm excited about this stuff. So don't hesitate to reach out. I'm trying to grow and learn.
Well, that's all for today on Build It Up. We will be back next week with another inspiring guest. Subscribe now so you will never miss our amazing interviews. Until next time, this is Bill Chen. Goodbye and take care.